Hey everybody, this is Greg Gossett, and today is Sunday, July 24th, 2022. Appreciate you stopping by and taking a look at my Gossett trading and mentoring weekend review of the trades that I took last week, how I'm managing them going forward, why I entered them. We're also going to take a look at some potential trades for me coming up this week. We are going to do a little bit about trader psychology. We're going to do trading poem, do all sorts of stuff today. Hope this is helpful. Hope you had a good trading week last week. It was nice to have the market go up. So that's the plan for today. So first of all, I am going to quickly run the U.S. legal disclaimer, and I will be back in 40 seconds. Hang tight. Thank you. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much. All right, thanks for holding through with me through that, and let's go to current positions. First of all, we'll start with the dailies. So I did buy Pfizer back here on, oops, that's not right. Bought this back here on June 17th, 2022. Had a nice confluence of signals. Of course, the way that I trade, the more confluence, the more combination of signals that happen at the same time. Or in other words, when you have multiple groups of buyers coming in for different reasons, increases the chance of you having a profitable trade. And the signals here on Pfizer were twofold. One, we had an intraday under 30 over 30. That was one signal. Then we also had an intraday rejection of the 300-day moving average. I bought this down here at 46.53. That was my entry price. My end of day stop would have been a close below the 300-day moving average, giving me a very, very good risk to reward ratio. And this has been a really nice trade, actually. Bought this at 46.53. It's 51.26. I always take a portion of my position off whenever it moves the value of 0.45 ATRs. Here it is right here. The current 0.45 ATR is 0.53. So with this position, I will take the closing price. I will add the value of the 0.45 to it. For Monday, that will be my first profit target. I'll take the first profit target, add the 0.53 to it again. That will be my second. I'll take the second, add the 0.53 to it again. That will be my third. And I will take 10% position size, 10% of whatever I have left of the position off. If it moves up that way, I'll just put them in as limit orders. But I like to play offense and defense with my trading. And offense or defense would be considered, where's my emergency stop? Where's my end of day stop? My end of day stop on this first trade here was just a simple close below the 300-day moving average. It looked really scary, but it worked. And then also when I buy and enter a position, I always look at what the value is of the of the 1.5 ATR. And if it moves that far above my entry point and gets to my trailing stop level, then I go into trailing stop mode. And then if I get a close below the previous day's low after reaching that, then I get out of half of the position. So I bought down here at 46.55. My 1.5 ATR trailing stop level was right above here. I think it was this day we went into trailing stop. So now I'm in trailing stop. Here I get my first close below the previous day's low. I sold half and locked in profits at 50.65, in at 46.53. So have some nice profit there. Like that it respected the 200-day moving average. We have earnings coming up. So, you know, it has not gone to a 65 RSI. If it goes to a 65 RSI, then if it closes below the 5 EMA, I'll get out of half. If it keeps moving up past the 65 RSI and rejects the 70 RSI, I will take half off. And then if it rejects the 70 RSI and then has a close below the previous day's low after that, then I will get out of the entire position. But we didn't quite get to the 65 RSI. We're holding my end of day stop of the 300-day moving average. This particular trade on the remaining shares up approximately 9.29%. So good trade, but most likely, unless we have a big move up or a big move down, the getting out before earnings will probably be where I will get out of the trade. But yeah, this particular trade with the remaining shares I have up about 9.29%. So good trade, good illustration of taking a confluence combination of indicators and it bouncing right away. So very happy with that trade. Rio is also another one of my daily swing trades. I did buy back here on the 15th of July with an under 30, over 30, and a V1 and a bullish engulfing bar. Bought here at 55.33. Now, when I buy, the very first thing I do is the most important part is, where is my emergency stop? And what I do with my emergency stop is, when I'm looking to enter a position and I see this signal, first thing I have to know is, okay, well, how many shares am I going to buy of this? The rule that I use, that's pretty easy, pretty standard, works well, but usually 1% of a person's trading account, if you have a hypothetical $100,000 trading account, 1% of that is $1,000. If it's $50,000, it's $500. If it's $25,000, it's $250. Whatever that is, then divide that by the value of the 2 ATR. You can see up on my screen here, ATR average true range 2 is 388. So if I was buying it right now and I had the $100,000 account, 1% of that's $1,000 divided by 388, which is the value of the 2 ATR. Tells me to buy 257.73 shares. So I round up to 258 shares. When I buy, if I were to buy it today and it moves down to 3.88, then that's my emergency stop. I'll get out and I will lose that $1,000. Now, I always have two stops. Initially, I place the emergency stop, which anytime it gets there, I get out. I'm an end of day trader, but if my emergency stop gets hit, I'm going to get out of the trade. Now, I also have an end of day stop. Where's my end of day stop? Well, I took this trade with the under 30, over 30. So if it were to close below the 30 RSI, I would get out. But in this particular case, I have the orange line here. What is that? You remember I was just telling you about the trailing stop level? Well, I bought here at 55.33. It did touch and reach my trailing stop level. So it moved 1.5 ATRs from my entry. Tomorrow, if we get a close below this low, I will get out. And alternatively, which may happen, if I take a trade at under 30, over 30, this is just for under 30, over 30s, but if I have an under 30, over 30 trade and it moves 1.5 ATRs, which it did, and then it goes back to my entry point, then I get out. Not on a rejection of the 200-day moving average, but if it's just an under 30, over 30, and it moves 1.5 ATRs and then comes back to my entry point, that is a bad sign because it's moved further than noise. But we'll see. Hopefully it will go up tomorrow. I don't know. But if it does get back to my entry point, I will go ahead and just get out at break even, although it's not break even because I have scaled out using the 0.45 ATR profit target approach that I use. But anyway, this particular trade up 3.88% approximately from entry to current price. And I am in trailing stop mode. So if I get a close below the previous day's low, I will sell half. Alternatively, if it just keeps moving up, then great. I will continue to take off 0.45 ATR profit targets. And lastly, if it comes back to my entry point, because it was an under 30, over 30, move 1.5 ATRs. If it comes back to my entry point, I will get back out at break even. But again, not break even because I did take profits when I had them, which is nice. All right, so I do trade multiple time frames, and I did have a trade over on the weekly time frame as well. I did enter this particular trade at 58.25 on DDM, double leveraged Dow 30. I bought this. The reason I bought this was because we had a close under, close back over the 200. That would have been a legitimate entry. I didn't buy it there. We came back. We bounced again at the 200 held. Next week, bounced again at the 200 held. Next week, the week that I bought it, we had a intra-week rejection, a pretty solid intra-week rejection and rejection of the previous low. I bought here 58.25. Of course, the purple line down here is my emergency stop, 2 ATRs below my entry. Orange line up here is my 1.5 ATR trailing stop level, which I've been talking about. And then end of week stop, well, why did I buy it? I bought it because of the rejection of the 200-day moving average. If it closes below the 200, I will get out. My emergency stop, again, down 2 ATRs from my entry. And how much would I lose if it gets down to this point? Well, if I was using a $100,000 account, 1% of the account for my maximum loss divided by the value of the 2 ATR, then I would lose the $1,000. So this particular trade is up approximately 4.07%. And I did hit one profit target earlier in the week. I believe it was Thursday when it moved up strong. It moved 0.45 ATRs from the previous week's close. And how much did I take off? I took off 10%. All right, so that's all I have then. Just a little recap on Pfizer. Bought Pfizer under 30 over 30. Intraday rejection of 300-day moving average 46.53. Got to trailing stop level. Took half off when we had the first close below the previous day's low. Continue to take my 10% profit targets when it moves 0.45 ATRs from the previous week's close. Has moved up, so every nice move up here. I took a little off when the market wanted it. Still not up to the 70 RSI level, still not up the 65 RSI level, still not a close below the 300-day moving average. So just holding pattern, and earnings coming up here on the 28th. So as you know, I always get out before earnings, and this particular trade up 9.29%. Rio, under 30 over 30, bullish engulfing bar, bought at 55.53. Did hit my trailing stop level, so I'm in trailing stop mode. This up 3.88%. And then, like I just mentioned, on DDM, intra-week rejection of the 200-day moving average, bought at 58.25, up 4.07%. All right, so like I said, I did go down through my watch list. I do have a handful of potential trades that I'm looking for next week. Generally, I need something to go up a little further or down a little further to find some support, or create some kind of momentum or some kind of crossover V1, V2 to the upside for me to get interested. So most of the time, I have to wait for something to go higher or lower for it to trigger my entry. But before we get into that, I want to talk a little bit about trader psychology. Today is a twofer. I have two trader psychology posts from Twitter, Anthony and Tom Canfield. Both traders, really respect them. You can follow Anthony at Anthony Crudell, and you can follow Tom Canfield at Canny4. And I liked both of these. That's why I snapshotted both of these. But Anthony says there's no big secret in market strategies from those that have had success from those that haven't. The difference is that successful traders know when to lose less and when to risk more. That's not something that's taught when learning a strategy. That takes experience. And it's really true. I mean, the longer you trade, the more experience, the more experiences, the more markets you've been through, and it does help. And I might add here that if you blow up your account, you're never going to get the experience you need. Take a look at trading as a long-term endeavor. One trade is just the next trade of the next 1,000 trades. And stay in the game. If you stay in the game, you are going to be a better trader because you've had the experience. It's just like if you want to learn guitar and someone takes your guitar and you bash it, they bash it up, or you bash it up, well, your guitar is gone. How are you ever going to get good? It's the same thing in trading. It's just that with money. If you lose all your capital, you're going to have to stop trading and you're not going to get the experience. So be conservative. Look at trading as a long-term endeavor, not something that you have to make the money back right away or make all this money right away. Look at it over the long term. If you look at trading over the long term, it becomes a completely different animal. So Anthony, thank you so much. And now let's go to Tom and see what Tom has to say. Denying your emotions won't solve trading problems. Humans are complex, filled with a basket of emotion. everything we are and do has emotion attached to it. So this mantra of trade without emotion sounds good, but it is not realistic. Confidence is an emotion. We need that. So true. Yeah, you do hear, get your emotion out of your trading. Well, yes, it'd be great, but like Tom says, we are human and we have emotions. It's hard to do that. Just don't act on the emotions. That's really what it comes down to. And he's right. Confidence is also emotion. We need that. So you do need emotions, but the negative emotions, the revenge trading emotions, the I have to get the money back now emotions, they never work. I'm telling you from experience. So, if you're new to trading and you start feeling frustrated, things aren't going your way, honestly, the best thing you can do is trade smaller, reduce your position size, just try to trade until you get some black ink or positive ink, get your confidence back like Tom was talking about. You need confidence as well. So anyway, thank you, Anthony, at Anthony Crudell on Twitter, and then Tom Canfield at Canny4 over on Twitter as well. Now, I always like to do a quick little poem from my friend Frank. You can follow Frank at FrankOD. He's a great trader, great author, great musician, and a great poet, and he specializes in poems about trading. They're always spot on, relevant to what's going on in the market, and let's see what Frank has to say today. When markets cry, we often know why. A high CPI, inflation awry, the Fed with its interest rates ready to fly. Stocks get pummeled, all sell, no buy. Markets can move with a breath and a sigh. Isn't that nice? One more time. When the markets cry, we often know why. A high CPI, inflation awry, the Fed with its interest rates ready to fly. Stocks get pummeled, all sell, no buy. Markets can move with a breath and a sigh. Well, we've had some buying lately, not all selling, but that can change quickly. So thank you, Frank. Appreciate the poem, appreciate the effort, really love it, and please keep them coming. All right. So like I said, I did pick a handful of potential stocks through my watch list. Let's take a look. First on board, AGQ. Well, I've been watching AGQ for a while. I'm looking for an under 30 and intraday and a rejection of the negative third ATR channel. 92% of prices fail at this third ATR channel, negative third ATR channel. Conversely, when you get to the positive third ATR channel, 92% of prices fail there. Not 100%, 92. But here we go. Silver did go under 30 over 30. I decided not to take it. I wanted to look for a little bit better setup. We did go under 30. It looks like on Friday. I'd like to see another retest of this negative third ATR channel and another retest of the 30 RSI. That would give me a double confirmation that negative third ATR channel and the 30 RSI is holding as legitimate support, and hopefully we can go up. So for me next week, I'm looking for another under 30 over 30 on silver. Or AGQ, which is double leverage. Silver obviously has come way down, anticipating a bounce, but I have to wait for the proper signal to get in. So AGQ, another under 30 over 30 is what I'm looking for, and ideally another test and rejection of the negative third ATR channel. Gold. Well, this is GDX. This is the Gold Miner Etf. You can see as well with gold, and you see I kind of like metals here, we have moved down significantly, down, although the last week we've kind of held support here. So that may be showing us there's a bit of a bottoming process. It did have an under 30 over 30 already. I didn't take it. You can see we had a big reversal, V1 reversal bar to the downside. It's 33.96. I would like to see it try to undercut this previous low back here on the 14th and another under 30 over 30. And I might want to add here, in this particular podcast, I do, try to tell you what the signals are. I can't get into all the depth just because of time constraints. So at the end of this podcast, I am going to talk about the lessons that I offer. I do offer private one-on-one lessons in the evening time via Skype. And in those lessons, I teach you everything step by step all 5 different trading approaches. So, but I also have things on my YouTube channel, Gossett Trading and Mentoring Live. I have free videos there under the lessons playlist. You can access those. Hopefully you can learn something from them. But if you really do want to, start learning something one-on-one with someone that's traded for 27 years, that's me, and that's why I provide it, and I'll talk a little bit at the end. But I just did want to say, I know I go through these setups pretty quickly, but that's just the purpose of this particular podcast. But if you want to learn the details, that's available to you as well. So on GDX, another under 30, over 30 is what I would be looking for. MACD did go positive. That is something good. I did look at the futures. Gold's down. So who knows? Maybe this week I will get the under 30, over 30. Alphabet. Well, there was a lot of hype about Alphabet splitting and it would go up and so forth, but as so often the market disappoints. We have earnings coming out here on the 25th of July. We're really nowhere near a potential entry right now. We're at 42.41. The reason I brought this up and I'm talking about it is if we get an under 30, over 30, if we get a bad report on earnings and we go under 30, over 30, that's where I will be looking to buy. Conversely, you could take the 520 crossover if it goes up. Don't know if it's going to do that, but like I said at the beginning of the show, I either need things to go up. If it went up and we had a 520 cross, that might be interesting depending how far it's run. But to the downside, which I'd really like to buy, Google, is a miss on earnings with an under 30, over 30. Johnson & Johnson. This is probably a pretty good teaching moment. Here we bounced at the 200-day moving average. You can see buyer stepped in. If you look back in time, and what I'm interested in Johnson & Johnson, I'm looking for Johnson & Johnson to come down and test the 200-day moving average. And why am I doing that? Well, one, it's the 200-day moving average. There should be some support there, but I like that I look back in time here. And you can see J&J, last time it rejected the 200-day moving average, it moved up significantly. There was a nice trade available there at the 200. It doesn't mean that just because last time it rejected the 200, it's going to go up again, but it gives you better odds that if the 200 was respected last time, it will probably be respected this time. So on Johnson & Johnson, this coming week, what I'm looking for is some kind of a close under, close over the 200, or some kind of intraday rejection or bounce again at the 200-day moving average. Coca-Cola, same. Look back. Did it respect the 200-day moving average last time? It sure did. It had a nice intraday rejection and then had a huge rally. Well, here we go. The 200 and the negative third ATR channel are right here in confluence. So if Coca-Cola were to come back down here, test that 200 and hold it, I would be interested. It does have earnings, unless we have a huge day down tomorrow and test the 200, which we may. Even then I wouldn't buy it because I'd be able to hold it for like 1 day. So really what I'm waiting for on Coca-Cola is to get past earnings, maybe a miss on earnings, maybe a test of the 200-day moving average or the 250 or the 300 as well. So that's what I'm looking for next week on Coca-Cola, a rejection after earnings, a rejection of the 200, the 250, or the 300-day moving average. Lockheed Martin. Well, this would have been a legitimate trade on Friday. It did bounce at the 200-day moving average. You can see the 200-day moving average is 394.12. Price is 394.73. So it did touch it, bounce above it, didn't take it. I'd like to see a double test of the 200-day moving average, another intraday below, and then close back above. That would make me feel better about it. I could also look for an entry with a rejection of the 250 or the 300 as well. MasterCard. Well, to me, this would have been a legitimate entry here to the short side with a rejection of the 200-day moving average and a V1 to the downside. V1s take into account 2 bars, bar 1, bar 2. This went above bar 1, closed below bar 1's close, also rejected the 200-day. That's a legitimate entry right there. And then on top of it, we are smack dab in the middle of a massive fair value gap to the downside. And I put this up here because I wanted to show you, this is not my channel, but it's an excellent channel, the Inner Circle Trader. And you can follow that on not Facebook, but on YouTube, my trading partner Ava is the one that exposed me to these fair value gaps, and they're pretty amazing. And so I would recommend you listen to video number 3, 6, and 9. And I get nothing from this. It's just someone that's a great trader with a great approach, and I wanted to point that out. And really what happened here, with ICT, they're looking for a run on liquidity, a structure break to the downside, and then a check back into that fair value gap. Well, the fair value gap is between here and here. And so we did run some liquidity. We changed structure to the downside. We've rallied back up into that value gap, which is a bearish situation. But this is a good example of blending ICT's approach with my approach, where we have a V1 to the downside, we have a rejection of the 200-day moving average, and we're in ICT's fair value gap, giving a good risk to reward. And what would be my risk to reward? Well, if I have taken this on Friday, if it closed above the 200-day moving average, I would get out, but I didn't take it. But if we get another attempt above the 200-day moving average and it closed back below, then I will short this. I'll put my 2 ATR emergency stop above. My end of day stop will be a close above the 200-day moving average. So this is what I'm looking for this coming week for a possible short on MasterCard, is another retest of the 200-day moving average inside of this fair value gap. All right, Merck & Company. Well, Merck & Company, same thing. We have a fair value gap. We had liquidity levels here. We broke the market structure to the downside here. I'm just waiting for a check back up into the fair value gap, which is beneath the high of this bar here and above the high, the low of this bar here and above the high is right here. This is the gap. This price action here was never efficiently tested because we moved down. So last week day trading had some good day trades on fair value gaps, but you have to be patient for them, wait for them to come back in. So I am looking at Merck for a short if we can get somewhere between 93.50 and 94.40. And again, check out ICT's page on YouTube if you want to learn more about fair value gaps. Philip Morris. Well, look, here's the 200-day moving average. We closed above the 200-day moving average, barely. 200-day moving average is 95.89. It's 95.93. If we get a nice gentle close below the 200-day moving average, I would probably be looking for a short. We had this big move down here, larger than 1 ATR. Whenever something moves more than 1 ATR, to me, it's significant. So we'll see what happens. But for me, if I get a close below the 200-day moving average, then I'll be looking for a short. UUP, which is the dollar. So the dollar has come off a little bit. There is no trade right now, but I looked at this and thought this was a good teaching moment. One of my favorite approaches is called the return to value V1 or V2. These two green lines here are considered the value zone. They're considered reversion to the mean. And prices are always going to move above them and then come back to the value zone. That's a good place for them to bounce and come back up and test another high. So what I'm looking for right now on UUP, clearly we were above the value zone here. I don't want to buy above value. I want to wait for it to come back into value. Well, you can see it's right in the value zone right now. Now, if I wanted to be aggressive and just buy it based upon this, I could. But I think the smarter move on this is once you come into the value zone, that you get a couple days of sideways motion. That shows that the price is, there are buyers there. They're acting as some support there, that it's not continuing to go down. So that's the first thing. Second thing, above the value zone, we'll come back into the value zone, which we have. We've had 1 day of sideways motion. This bar, the current bar, went below, so it starts all over. I need 2 days of sideways motion here, and then I'm looking for a V1 or a V2 entry to give me a good risk to reward. And again, this is something that I teach in my classes. I also have a free video on YouTube about V1, V2 entries. They're one of my bread and butters for day trading and swing trading. So, go watch it. It's free. V1, V2 entries on my YouTube channel. So again, we're above the value zone, into the value zone, looking for some sideways motion to show that there's some equilibrium and some support there, then I'll look for a V1 or V2 entry for a move back up, if and when that happens. XLE. All right. Well, similar to, what was it? Gold, and what was that? GDX. Last time we had to close under back over the 200-day moving average. It would have been a good trade, right? You would have bought here at about 68.59. We got up to 73. We did have a down day on Friday. I'm looking for another close under, close over the 200, intraday rejection of the 200, or bounce at the 200. MACD is green. I like that. So I'm hoping it's going to come down, bounce, give me a good risk to reward ratio. Utilities, XLU. Well, we lost the 200-day moving average. We've rallied back up into it. If I get, I could go either way on XLU. If it rejects the 200-day moving average and closes below, I could get short. If it closes above the 200-day moving average, I could get long. If I'm long, I want to have it as support below me. If I'm short, I want to have it as resistance above me. But right now, it hasn't tested the 200 yet. It did over here and failed, but I didn't trade it over there. So what I'm looking for on XLU is a rejection of the 200 above and close below. That would be a short. Or if it closed above the 200-day moving average, I could consider that a long. We had a big down move here. My bias is actually to the downside because we had a bar that was larger than one ATR to the downside. When that happens, a lot of time you get a check back, rally back up in. But when you have a big down bar like this, a lot of the time, once it gets to halfway of this bar, it will fail. And you can see this big down bar, these bars here did come into about halfway, tried to go above, failed, and then we had a bit of move down. So my bias on this particular stock would be to the downside, but I still need a rejection of the 200-day moving average. And then Zoom. Zoom is another fair value gap, as I was mentioning before. Again, kind of basics on fair value gaps. You need a level of liquidity. Here's a swing high. It got ran. Then this bar took out the first swing low, which changed the structure to the downside. Looking for a check back into the fair value gap. The fair value gap is the distance or the space below this low and this bar's high right in here. This is where the check back. And you might add, well, Greg, if you took that short, where would you get out? I get out with a close above the first swing high. I would still put my emergency stop, all that kind of stuff. But again, look at ICT's channel on YouTube. Watch lesson number 3, 6, and 9. He goes into depth, and it's a really, really good approach. So anyway, that's what I'm looking at for next week. Those were the trades that I've been managing, the Pfizer, the Rio, and the DDM. I hope you have a good week next week. It's going to be probably a pretty volatile week. We have earnings from Microsoft. We have earnings from Apple. We have economic news. So as always, please be careful, be patient, position size correctly. And like I mentioned near the beginning of the podcast, I do teach private one-on-one lessons in the evening time. I love to teach. I've taught people from all over the world. I have been trading for 27 years. I have 5 different trading approaches that I use and I love that work in all sorts of different markets. In the course, I teach you step by step how to trade these. I don't let you go from the lessons until I feel like you really have got it. We do a lot of simulation trading. And you're going to learn a lot. The cost of the course, $1,750, but I promise you it's worth every penny, and you're going to be a better trader. That's it. So if you're interested, I have an email in the link of this YouTube channel. Just send me an email. Say, Greg, I'm potentially interested in taking your one-on-one course. I'll reply back and say, great. Let's set up a Skype call. The Skype call is free. I just want to learn more about you and your trading challenges, your goals. It's a great time for you to ask me questions about the course, specific questions. And then when we're done with the call, it's on you. You can think about it as long as you want. I will never reach back out to you. You're going to have to contact me if you want to schedule lessons, but I hope you do because you're going to learn a lot. I always become friends with my students, and you're going to learn a lot of good information. So send me an email and we'll start the process. Number 2, I have a great online course available at udemy.com. It's called the Deep Dip by Stock Trading Strategy. Have sold so many of those around the world. Such great reviews, such great feedback. And if you're just starting to trade, trade, it's a great place to start. The course is only $12 or $15, but it's a significant course. It has 9.5 hours of video, it has 26 videos total, 15 study guides, and I just can't think of a better way to start trading and learning about position size, emergency stops, end of day stops, profit targets, overhead resistance levels, all that kind of stuff. It's all covered in there for 12 or 15 bucks. So if you're interested in that, the link, the Udemy link is in the description. And then lastly, if you like today's podcast, if you're finding it helpful at all, or possibly one of the ones in the past, if you could hit the thumbs up button, I would really, really appreciate it. It lets YouTube know that there's some good, valuable content here, and they'll get out and share it more on YouTube. So I hope you have a good upcoming week. I hope you can go out, try to do something nice for another human being today. It would make the world a better place if we could all do that. If you could also go out, do something nice for an animal, that would be a great thing. I was raised with animals my whole life. They appreciate acts of kindness just like humans do. And, one day, possibly you'll need it, and I hope someone is there for you. So have a great rest of your weekend. Be careful next week. Be patient, position size correctly, all that kind of stuff. If you have any comments, you can leave them down below. But appreciate you spending the time, everyone, and I hope to talk to you next week. And on the way out here, I have to run the U.S. legal disclaimer. Thanks again for tuning in. Hope to talk to you all soon. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.